In a world that changes seemingly every day, new technology, we're on the cusp of change, it seems like around every corner. History, however, when it comes from an investing standpoint, teaches us a lot of very valuable lessons. And a lot of things from an investing standpoint, from sound investing, disciplined investing, really never change. So it's important as investors that really want to reach long-term financial planning goals and having a life by design that's supported by their balance sheet, not dictated by their balance sheet. It's important to find these lessons and to make sure that they're consistently implemented inside your financial plan. So I want to take a moment and look at some of the data that we captured in 2023 and how that's going to affect us in 2024 moving forward. So first of all, I wanted to look at bond market. So a lot of people think of bonds as boring, safe money, which they really are. Now, what we found in 2022 was the bonds dropped about 13%. That's because interest rates skyrocketed and people that had bond investments paying 2 or 3%, they weren't able to go out and sell those to other bond investors who could, with new money, go purchase a bond paying 5, 6, or 7%. So that's why you see if you had to sell your bonds in 2022, you'd have had to take a bad loss. And it's actually, this shows from 1926 to 2013. If you look at the U.S. aggregate bond index, which right now just has an average of a 6.1 year duration. Historically, it's around 4.9 or about 5-year duration. 2022 was one of the worst years ever. However, if you look at 2023, this fit kind of in the average returns where you're getting 3 to 7%. To 2023, there was a 5.5% return in that 5-year duration bond. And investing after a year like that, the following years on average return 4.4. So with interest rates, coming down or stabilizing, safe money is important to have, especially if you're retired or if you're going to have a goal that's coming to fruition in a short time frame. We wouldn't recommend to mix this with the equity markets, but it's really important to understand your liquidity position when it comes to bond investing. Is the money going to be there when you need it the most? And layering the duration of your bonds to have a liquidity plan is crucial. Next up, let's look at stocks. So if we look at S&P 500 returns from 1926 to 2013, one of the greatest reasons we are big disbelievers in any kind of index annuity or index insurance product that caps the downside but also caps the upside is if you look at the data, there are so many years which are 8% or above. And in fact, the biggest block here in the stock market is when you have these great years, typically in earlier mid-stage economies, that have amazing years. And so 2023 was one of those, 26% return on the S&P 500. And the average, if you invest after a year in which stocks had a great year in this block, your average return would have been 10.5% the following year. So that's really good news for investors that want to, obviously we recommend always stay in the market. And you look at the really bad years, see how limited those are over here. And you have to go through some of those bad times in order to make sure you're there for the good times. So you look at how much positivity we see versus the negative. There was 26 years that were 0 or negative, and the remaining years, almost over this 100-year period, were positive. That's why I always say, statistically, the market's up 75% of the time and only down 25% of the time. So obviously a good year to be in stocks, and moving forward, it will always be a great year to be in stocks, great decade, hopefully multi-decades for the rest of your life. Just always having a fail-safe and plan, because during those 26 years, obviously you don't want to have to pull from anything at a loss. That's the number one rule of money is, don't lose money. Okay, so we also have a election year, and actually statistically, 49% of the population in the world will be voting. Many countries across the world have major election years. So there's going to be 2024 is really the year of the unknown. What does this mean for the stock market? Well, if we look at historically stock market returns during presidential election years, the first 2 quarters are typically slow, and then the third quarter and the fourth quarter are much bigger. But we never recommend to mix politics with your investment policy statement. Republican and Democrat, specifically in the United States, have had very similar within 1% differential in returns over history. Sometimes Republicans being better, sometimes Democrats being better. What's in common is most people that say, oh, it's going to be bad, usually it's good. Most people that say, oh, it's going to be good, it's going to be bad. It's typically the inverse of what most people think. Best thing is don't mix your politics in with your investing statements. This is some interesting data on inflation. If you look at the returns following when inflation rates peaked, all but one time in the following 12 months have been positive. The only negative return that we saw was during the financial crisis in 2008 when inflation had peaked. Every other time inflation had peaked, there have been very substantial returns in equity markets and in bond markets, all but one time, when interest rates crushed in 2022 when it went way up, obviously there. So with inflation rates, if in fact they have peaked and now they're tapering down, that's usually a good sign for in investing. So some other data I wanted to look at is a lot of people look at, what did the S&P 500 do last year? It did 26%. Why didn't my diversified portfolio do that well? Well, if you have a 1-year goal, you shouldn't be invested anyway. So we shouldn't be paying attention to anything over 1 year. But if you look at the last 20 years, and this is the S&P 500. So this is if you had S&P 500 investment on a $100,000 investment versus a diversified portfolio, 24% large, 24% mid, 5% international, 2% small, 5% emerging, and then 40% between the mix of bonds. So the first period we're going to look at is the tech bust. S&P lost 40, diversified portfolio lost 15. Then the U.S. market recovered great, 82.9. Diversified went up even more, 91.5. Financial crisis hit. You lost money no matter what, but obviously less money with the diversified. Now, the next 10 years were tough because S&P 500 absolutely crushed it, 350% versus diversifying 237. And then there was another down year during COVID, and then an up year, and then we had a down year during 2022, and then an up year. And so despite you feel like, oh, this diversification, I still lost money when the market down, and I didn't make as much money on the upside. Limiting that oscillation, if you look at the two results here, 100,000 and straight up S&P 500 grew to 490,000 over those 23 years versus if you were in a diversified portfolio, 100,000 grew to 491,000. So you actually essentially halved your risk and got a little bit better return along the way. And by the way, if you needed money along the way, you had the optionality of which bucket to pull from. So obviously, diversifying from so many levels is the way to go if you are a long-term investor, which anyone that has a financial plan in place, I would categorize as a long-term investor. Anyone that has a short-term goal in place, such as buying a house next year, your money shouldn't be invested in anything under any circumstances. It should be in some, low duration treasury bond or even cash or a money market, etc. So hopefully that data was helpful, and obviously excited for the good times ahead in 2024. And more importantly, the decades, 10, 20, 30, 40, 50 years plus, where compounding interest in diversified equity markets can really be a catalyst for your financial success.